Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Protalix BioTherapeutics, ticker PLX, based on the highly compelling material submitted by our listener.
And it is a fascinating case.
It really is. Our mission today is to unpack the core conflict right away because it's a fascinating anomaly in the biotech space. We are looking at a commercial stage biotech that appears to be trading at a massive valuation disconnect.
Right.
A company that possesses a debt-free balance sheet and a validated proprietary plant-based platform. I mean, these are two factors that typically command a premium, but they seem to be completely ignored by the market right now.
Exactly. And that's the central inquiry for this deep dive. It's fundamentally about transition and perception. Is the public market correctly valuing Protalix's move from being a successful debt-laden turnaround story
Right, getting those two products approved?
into a fully operational, sustainable growth phase? And that whole valuation assessment, it really hinges on two massive levers. First, the projected $100 million plus annual royalty ramp for their Fabry disease treatment, Elfabrio, by 2030.
Okay, that's number one.
And second, the really high potential of their, what they believe is a best-in-class gout candidate, PRX 115. That one could open up a multi-billion-dollar segment all on its own.
So let's start at the very beginning with what makes this company so unique. Because before we can even talk about dollars and disease markets, we have to talk about the technology that creates a true competitive barrier here. We're talking about the ProCellEx platform.
Yes.
This feels like the technological anchor that really de-risks the entire operation.
It absolutely is the technological anchor.
Yeah.
And you can't overstate its importance. It's what transforms Protalix from just another small-cap biotech into a vertically integrated manufacturer. The core differentiator is how they produce their therapeutic proteins.
And how is that?
Well, while 99% of the industry relies on standard mammalian cell lines, often Chinese hamster ovary cells or CHO cells,
Right.
ProCellEx uses its proprietary ProCellEx protein expression system. And this system, it relies on genetically engineered plant cells.
Plant cells. We're talking about carrot cells, I believe. I have to ask, beyond just the novelty of it, why is growing therapeutic enzymes inside engineered carrot cells inherently better than the industry standard?
Okay, so the benefits are layered. They touch on safety, operational efficiency, and maybe most importantly, cost. This is the real moat.
Let's start with safety.
On the safety front, the advantage is profound. Plant cells are completely immune to the common viral contamination problems that can absolutely cripple mammalian cell systems.
So if you get a viral outbreak in one of those huge bioreactors full of CHO cells, you're in trouble.
You're in huge trouble. You could lose millions of dollars worth of product, suffer a crippling production shutdown that could last for months, and that impacts the global supply. It's a catastrophic risk.
A risk that Protalix simply doesn't face because they're using plant biology.
Precisely. They've engineered that risk right out of the equation. And that resilience was actually tested and proven critical during the peak of global supply chain instability a few years back.
Interesting.
Furthermore, this plant-based approach allows for a vastly different manufacturing setup. We're talking about operating at a lower biological containment level.
Why is that?
Because the risk of a human pathogenic contamination is, it's non-existent. And that translates directly to financial savings.
Okay, let's nail down that financial advantage. Our sources suggest the manufacturing cost differential is, frankly, staggering. How much does this ProCellEx platform actually save them in hard infrastructure and, operational spending?
The estimates are dramatic. Protalix is able to perform what they call open-loop manufacturing. They do it in these large disposable polyethylene bioreactors, and they can run it at room temperature or even refrigerated temperatures.
Which means less complex equipment.
Far less. By moving away from the complex, high-sterility, tightly controlled environment you need for mammalian cell culture, the proprietary sources indicate the system cuts facility costs by potentially two-thirds.
Two-thirds. That's not a small efficiency. That's a structural competitive advantage that can feed profit margins or let them be more aggressive on pricing.
Absolutely. It means lower capital expenditure to scale up production, lower operating costs, less energy, less complex sterilization, and much greater manufacturing capacity utilization. This is why Protalix is able to maintain its role as the sole manufacturer and supplier of the drug substance in all its major partnership agreements.
Even with Pfizer and Cheesy.
Especially with them, that vertical integration guarantees supply chain security and reliability, which is a massive and I think unappreciated de-risking factor for their partners. It's a core insight. This technology really does transform Protalix's entire risk profile.
That sets a fantastic technological stage. So now let's pivot to the commercial assets built on this foundation. We have 2 approved products, Elaiso and Elfabrio, both tackling lysosomal storage disorders. We should probably start with the growth vector, which is Elfabrio for Fabry disease.
Right. Fabry disease is the critical target here. It's a rare X-linked genetic disorder. It affects roughly 1 in 40,000 to 60,000 men globally.
And what's the underlying mechanism of the disease?
The problem is a deficiency in an enzyme called alpha-galactosidase A. And when that enzyme is deficient, a specific fatty substance called galbotryosylceramide or GB3, it can't be properly metabolized. It just builds up.
And where does that accumulation happen, and what's the damage?
GB3 accumulates pretty much everywhere. In blood vessel walls, the kidneys, the heart, the nervous system. The damage is progressive and insidious. It leads to really severe outcomes like renal failure, life-threatening cardiomyopathy, and stroke.
And the standard of care is just replacing that missing enzyme.
It is. It has been and remains enzyme replacement therapy, or ERT. You're just putting back the enzyme the body can't make.
And Elfabrio is Protalix's second approved ERT, cleared by the FDA and EMA back in May 2023. We've established the market is sizable, about $2.0 billion in 2023, expected to grow to maybe $3.4 billion by 2030. So what allows Elfabrio to challenge the entrenched incumbents like Fabrazyme or Replagal?
The edge is entirely based on drug design and pharmacokinetics, which is all facilitated by the ProCellEx system. Elfabrio, the drug's name is pegonugades alpha, is chemically modified. It's a process known as pegylation.
Pegylation. So this is where they attach these polyethylene glycol or PEG chains to the enzyme molecule.
That's it.
We've heard the term protective shield used before, but for our learner, let's get a bit more technical. What does adding those PEG chains actually do to the enzyme inside the body, and why is that so critical for a rare disease treatment?
So the PEG chains increase the enzyme's effective size, what's called its hydrodynamic radius. Imagine wrapping a tennis ball in a big layer of cotton wool. It's just bigger now.
Oh.
When that enzyme circulates in the bloodstream, the kidneys are constantly filtering things out. By increasing the size via pegylation, the drug is less efficiently filtered out by the renal system. It just sticks around longer. Plus, that protective layer also minimizes the enzyme's exposure to the immune system.
So we're decreasing the clearance rate and potentially decreasing immunogenicity, which is a huge concern with these kinds of therapies. What is the measurable clinical outcome of this modification?
A significantly prolonged plasma half-life. And this is the central competitive advantage. The data shows Elfabrio's half-life in humans is approximately 80 hours.
80 hours.
Should pause and just appreciate that number. The other commercially available ERTs, like Replagal or Fabrazyme, have half-lives of less than 2 hours.
So we are talking about the difference between minutes of persistence and several days.
It's a staggering differential. It's not an incremental improvement. It's a paradigm shift.
And if the drug is active and present in the plasma for that long, for days, that fundamentally changes the clinical picture, moving us directly to the potential dosing frequency catalyst.
Exactly. The current standard of care dictates dosing every 2 weeks. That usually means a patient has to go to an infusion center multiple times a month to the rest of their life.
Which is a huge burden.
A massive burden. So because of Elfabrio's superior 80-hour half-life, Protalix's partner, Chiesi, pursued a game-changing label expansion. In December 2024, they submitted a variation application to the European Medicines Agency, the EMA, seeking approval for a less frequent dosing regimen of 2 milligrams every 4 weeks.
Monthly dosing versus biweekly. That is a huge deal for quality of life in any chronic disease setting. It's not just compliance, it reduces the burden on the patient, on their family, on the entire healthcare system. But this is also where we hit the most pronounced regulatory risk factor in the Elfabrio story.
It is. This is where it gets tricky. The EMA process proved difficult. Despite what seems like compelling pharmacokinetic data, in October and November of 2025, the EMA's CHMP issued a negative opinion on that requested every 4-week dosing regimen.
Ouch. That's a significant hurdle. That monthly dosing is really the key to achieving maximum market penetration, isn't it? To capturing that highest end segment of the market.
It really is. So the market is currently viewing Elfabrio as, a viable biweekly ERT competitor,
Mm.
but not necessarily the paradigm shifter it could be if it were approved for monthly dosing.
So what was the immediate response from Protalix and Cheesy to that negative opinion? They didn't just accept it, did they?
No, they immediately requested a re-examination. This signifies their strong conviction in the clinical evidence they have, particularly from the Bright study data, which indicated clinical non-inferiority with the monthly regimen.
So the fight's not over.
Not at all. This regulatory battle for the longer interval is still ongoing, and the outcome will heavily influence whether they can achieve their ambitious long-term royalty forecast. A monthly dose approval would dramatically increase the likelihood of capturing that 15% to 20% global market share goal.
Let's discuss the financial mechanics of that goal. Protalix transferred the global commercialization rights to KZ, which is a global pharmaceutical powerhouse. This means Protalix is highly insulated from marketing and commercial execution risk, but they are completely dependent on Thesis' success. What does that revenue split look like?
It's a classic tiered royalty structure. It's designed to reward Protalix as sales volume increases. So Protalix receives tiered payments for the drug product purchased by KZ. Ex-US, those payments range from 15% to 35% of net sales.
And in the U.S.?
In the lucrative U.S. market, the structure is even more favorable. It ranges from 15% to 40% of net sales, all depending on the annual sales volume that GZ achieves.
That 40% top-tier royalty is incredibly high for a partner who isn't doing the selling. And this is the engine that's driving this entire long-term bullish thesis, isn't it?
Correct. Management has been quite vocal about their sales forecast. Based on Cheesy's projected ramp-up in market penetration, Protalix anticipates annual royalties from Elfabrio alone will exceed $100 million by the target year of 2030.
$100 million a year.
And some sources suggest a potential range stretching even higher, maybe between $120 million to $150 million annually.
And beyond the guaranteed royalties, there's also this massive embedded upside in milestone payments, correct?
Yes, that's the other part of the deal. Protalix is eligible for up to $0.5 billion in total regulatory and commercial milestones from KZ. Now, that $500 million figure is contingent on deep market success and, hitting various commercial hurdles.
Of course.
But it represents the full, massive long-term value that's embedded in this agreement. The key here is that the foundation, the technology, and the manufacturing reliability is entirely Protalix's, which secures their position as a high-margin royalty recipient.
So Elfabrio is the high-growth, high-reward vector for 2030. Now let's turn to the other approved product, the steady base that funds the company's current operations and strategic expansion. Elfabrio for Goucher disease.
Eliso, or teliglucerase alpha, is crucial. It's so important because it was the original validation of the entire ProCellEx platform. It was the first plant cell-derived recombinant protein ever approved by the FDA way back in May 2012. It treats Goucher disease, another rare LSD, which causes lipid accumulation, leading to enlarged organs, bone disorders, and anemia.
This product has been providing reliable revenue for over a decade now. What does the current commercial structure look like for Elfabrio?
It's dual-pronged. The primary partnership is with Pfizer, which holds the worldwide exclusive license for every market except Brazil. Protalix remains the sole manufacturer and supplier of the drug substance.
Then Brazil?
Separately, they have an agreement with Fiocruz, which is an arm of the Brazilian Ministry of Health, for the Brazilian market, so they have that market carved out.
Which makes Protalix essentially a stable, high-tech factory fulfilling orders for two large partners. How stable is that revenue stream?
It's incredibly stable, though it's highly dictated by the supply contract structure. Sales in Brazil, for instance, through that Fiocruz agreement, totaled approximately $10.4 million in fiscal year 2023. Eliso maintains a solid market share there of roughly 27%. This provides a consistent, albeit lower margin, base of revenue that covers a lot of operational costs. It's their cash cow.
A cash cow, right. But I think there's a massive hidden catalyst associated with Eliso 1 that could unlock a substantial new growth phase for the product itself, even after all this time.
Absolutely. This is the long-term play. The contract with Pfizer, which was signed way back in 2009, is tied to the expiration of the last Protalix patent right, or the end of the supply term. As that winds down, there's growing speculation about what happens next.
And the potential catalyst is?
The potential catalyst here is Protalix reclaiming the marketing and distribution rights from Pfizer globally, or at the very least renegotiating the terms for much higher margins. This could move Aliso from being a supply-based, fixed-margin cash flow generator to a higher-margin, fully capitalized asset for them.
And the timing on that.
Potentially around 2030, which would mirror the peak Elfabrio royalty ramp. You could see both assets hitting their stride at the same time.
So we have the past with Liso's validation, the near-term future with the Elfabrio royalty ramp, and now we have to move to the next layer of potential alpha, the pipeline. And the most compelling asset is PRX 115, aiming for the massive uncontrolled gout market. This represents a pretty significant shift away from focusing solely on ultra-rare diseases.
It does. This is Protalix stepping out of the niche rare disease corner and swinging for a potential blockbuster. Gout is highly prevalent. It affects roughly 14 million patients in the U.S. alone.
But most of that is managed with generics, right?
Yes, but PRX 115 is targeting a very specialized, very crucial submarket. The estimated 5% of patients who suffer from chronic refractory disease. These are the patients who fail standard therapies, and they represent a massive unmet need.
What's the size of that addressable refractory market?
The overall market for gout treatment is sizable, sitting around $1.4 billion and growing. But that refractory segment, while it's smaller in patient count, it represents very high-value treatment. The current standard bearer for this segment is a drug called Crysvita, an intravenous uricase enzyme.
A billion-dollar drug. So what exactly is PRX 115, and how does it aim to unseat a billion-dollar-plus established incumbent?
PRX 115 is a recombinant pegylated uricase enzyme, produced, you guessed it, using the ProCellEx platform. Like all uricases, its function is to rapidly lower urate levels by converting urate into easily eliminated allantoin. Its competitive edge, identical to Elfabrio's, is driven by superior pharmacokinetics and therefore superior convenience.
Okay, let's look at the phase I data. This is where the long half-life thesis for PRX 115 really came into focus, wasn't it?
Yes. The phase I study was a single ascending dose trial. It involved 64 subjects with elevated urate levels, and the results were, frankly, remarkably encouraging. The study showed a stable pharmacokinetic profile and a very long half-life.
What's the critical data point?
The duration of effect. Detectable drug levels were observed in the plasma for up to 12 weeks in the highest dose cohorts.
12 weeks? That's 3 months. If you can maintain efficacy for that long, that supports the possibility of monthly or maybe even bi-monthly dosing. Why is that such a game changer in this specific market?
It's a massive competitive differentiator. Because the current market leader, Crysvita, it requires an intravenous administration every 2 weeks.
Every 2 weeks for life.
For life. Think about the burden on a patient suffering from chronic refractory gout. 2 weekly visits to an infusion center versus potentially 1 visit every 1 or 2 months. If PRX 115 can achieve that in phase 2, it significantly improves compliance, it drastically reduces healthcare costs, and it positions it as a genuine best-in-class candidate.
I have to play the skeptic on the phase I data, though. We often see great results in early-stage trials that, fall apart later. And specifically, our sources mentioned one serious adverse event in the phase I trial, an anaphylactic reaction. That is a major concern, particularly because immunogenicity and anaphylaxis are the main risk factors with Crysvita, the incumbent.
That is the right question to ask. Anaphylaxis is the Achilles heel of the current uricase treatments.
So how confident is Protalix in mitigating that key risk?
Well, the fact that PRX 115 is also pegylated helps reduce immunogenicity, but it doesn't eliminate it. Protalix's team has stressed that the one serious event occurred in an early cohort, it resolved fully, and importantly, it was not repeated in subsequent subjects.
Which suggests it might have been an isolated issue.
It suggests it might have been isolated or manageable, perhaps due to different preparation or administration protocols in the later cohorts. But you're right. The shadow of that risk remains. If phase 2 shows a high rate of infusion reactions, the differentiation is gone, and the entire value proposition collapses, regardless of the dosing interval.
So that's the risk.
That is precisely the execution risk baked into this pipeline asset. However, the data was clearly strong enough to support moving forward rapidly. The investigational new drug application for phase 2 became effective as of October 2025.
And when do they start?
Protalix is anticipating commencing the phase 2 study in uncontrolled gout patients in the 4th quarter of 2025. They plan to use 20 to 30 sites, mostly across the U.S.
And what's the time frame for results, assuming the trial proceeds efficiently? When do we get to see the data?
We'd anticipate preliminary readouts, especially on safety and primary endpoints, potentially surfacing in late 2026. Comprehensive results would likely be available in the 2nd or 3rd quarter of 2027.
Okay, so Q3 2027 is the big date. If those results affirm the monthly or bi-monthly dosing and show a clean safety profile,
Then this valuation disconnect we're talking about will close almost instantaneously.
the combination of Elfabrio and PRX 115 shows a company that's aggressively pursuing high-value, high-reward opportunities. But this ambition requires capital, and that brings us to the Protalix 3.0 strategic pivot, which seems to suggest they aren't just relying on their current tech base anymore.
That's the key takeaway for the future. The Protalix vision, or Protalix 3.0, is about deliberately expanding their technical capabilities beyond the ProCellEx platform, which they now view as their stable manufacturing house. They're pivoting from being primarily a recombinant protein company into a multimodality development organization.
Well, what new territories are they exploring?
The strategic focus over the next 3 years is ambitious. They're aiming to build a significant pipeline encompassing 4 to 5 discovery to phase 2 programs. This expansion is explicitly aimed at diversifying their risk and maximizing future growth. And they're looking at new modalities.
Like what?
New drug delivery systems, chemical modification techniques beyond just simple pegylation, and most importantly, moving into small molecules and oligonucleotides.
Oligonucleotides. That's a huge technologically intensive leap. We're talking about ASOs, antisense oligonucleotides, which operate at the level of messenger RNA to stop or start protein production. That requires a completely different expertise, manufacturing, R&D structure.
And growing enzymes in carrot cells, yes. It's a significant shift, and they are leveraging partnerships to execute this pivot. A notable example is that their partnership announced in December 2025 with a company called Secarna Pharmaceuticals, an ASO specialist.
Okay, so they're buying the expertise.
They are. The partnership is designed specifically to develop antisense oligonucleotides for rare kidney diseases.
And what technology are they getting from Secarna?
Secarna brings its proprietary OligoCreator AI platform to the table. This platform uses computational power and advanced algorithms to design oligonucleotide drug candidates with high speed and precision. The goal is to aim for optimal efficacy and minimized off-target effects right from the start.
So this is a deliberate, calculated move by Protalix to access next-generation drug design capabilities without having to spend a decade building that expertise internally from scratch.
Exactly. It's a very smart way to pivot.
And the target disease space for this 3.0 vision rare renal diseases, that's also strategic, right? Why renal?
It leverages their established track record in rare genetic diseases while simultaneously targeting an area of high unmet medical need where current therapies are often, inadequate.
Right.
Rare renal diseases, both genetic and non-genetic, represent highly specialized markets where regulatory pathways can sometimes be streamlined.
So it's a diversification play.
It is. This ensures that if PRX 115 fails in phase 2, the entire future growth story isn't tied solely to the Elfabrio royalty ramp. They are consciously building a second, distinct, long-term foundation based on RNA therapeutics and other modalities.
This sounds like a biotech that's really maturing, using its debt-free cash flow to fund high-risk, high-reward expansion. But this is exactly where the valuation disconnect becomes so jarring. They have the proven tech, the commercial base, the best-in-class pipeline asset, and the strategic vision. Why, then, is the market treating this company like a generic, early-stage research outfit?
We have to address the financial health again, because it's the foundation of this entire anomaly. The financial risk profile for Protalix has been drastically de-risked. They successfully repaid all outstanding principal and interest on their convertible promissory notes in September 2024. This is crucial. They are operating from a debt-free balance sheet, aside from standard operating lease liabilities.
That alone should be celebrated by the market. A debt-free biotech. How healthy is their cash position right now?
Very healthy. As of September 30, 2025, they reported a strong current asset position, $13.6 million in cash and cash equivalents, and an additional $15.7 million in short-term bank deposits.
So nearly $30 million in liquidity?
Yes. And management anticipates generating positive free cash flow over the subsequent 12 months. That means they are financially independent and insulated from capital market volatility, unlike almost all of their small-cap peers.
So if they are debt-free and cash flow positive, why do investors look at the quarterly earnings reports and see chaos? This takes us to the central issue obscuring the value, the lumpy revenue recognition challenge.
This is the most crucial piece of noise causing the valuation disconnect, and it's due entirely to their business model as a supplier. Because Protalix acts as the bulk manufacturer for its partners, Pfizer, TSE Veracruz revenues are recognized upon the bulk delivery of that drug substance. They are not selling directly to patients month by month.
So the revenue is entirely driven by their partners' inventory cycles. They might need a massive $15 million batch in Q1, and then they sit on that inventory for 6 months, meaning Protalix reports zero or near zero sales to that partner in Q2 and Q3.
That is exactly right. This timing mechanism creates a massive amount of volatility and makes quarter-over-quarter comparisons utterly misleading for any investor who isn't digging deep into the 10Q filings. It creates this lumpy effect where one quarter looks like massive growth and the next looks like a major contraction.
It must confuse the entire retail investment base.
It does. Let's use the actual data to illustrate this distortion.
Priya.
Okay, consider the third quarter of 2025. Sales to Fiocruz in Brazil spiked significantly to $6.1 million. This timing created a strong Q3 Brazil number. However, sales to Kizzy in the same quarter dropped year over year, which just reflected a decrease in their bulk purchase timing.
And the quarter before.
Conversely, Q2 of 2025 saw a large increase in sales to Kizzy, $8 million due to a major order, but a decrease in sales to Brazil in that same period. If you only look at one partner's sales in isolation or compare Q3 to Q2, the figures bounce around wildly.
The signal, therefore, is not in the quarterly report, but in the trailing 12 months. What does the true underlying momentum look like, stripped of that lumpiness?
The signal is unmistakable growth. For the 9 months ended September 30, 2025, total revenues from selling goods were $43.1 million. That marks a robust increase of 24% from the prior year period.
24% growth.
Yes, the growth trajectory is clearly there, supported by demand for Elaliso and the rapid commercialization ramp of Elfabrio. But because the quarter-to-quarter recognition is so messy, the market appears unable to price in this underlying momentum effectively.
This brings us back to the investment case anomaly. If you are debt-free, growing at 24% annually, have 2 approved products, a protected technological moat, and a promising late-stage pipeline, you would expect a valuation that reflects a solid biopharma firm, not a microcap struggling to find its footing.
The disconnect is stark. Protalix is currently trading at a price-to-sales ratio often seen around 1.2x. Compare that to peers in the rare disease space, many of whom are heavily indebted, still in the clinic, or rely on complex licensing deals. The valuation gap becomes profound. The consensus opinion from firms like Zacks Small Cap Research is that the shares are substantially undervalued.
And Zacks, as of February 2025, maintained a highly defined specific price target of $14 per share. That suggests an expected multifold return from the current trading price. What assumptions are underpinning that aggressive target?
That target is built upon pricing in the stable, reliable supply revenue from Elaliso, combined with heavily factoring in the high probability Elfabrio royalty stream toward 2030. The one management projects at over $100 million annually. Essentially, the analysts believe the market is severely discounting the value of guaranteed, high-margin, long-term contractual revenue.
And there's internal confidence to match that external valuation. We noted that management, specifically the CEO, has been reportedly aligning their incentives with shareholders.
Yes, that management alignment is a strong internal signal. The CEO has been actively buying shares in the open market and reportedly taking compensation bonuses in stock. This signals a strong internal conviction that the current trading price does not reflect the long-term defined value proposition centered around that $14 target. They're betting their own money on this.
So, to synthesize this entire deep dive, Protalix has mitigated the primary risk factor of small-cap biotechs, which is capital raising and dilution, by becoming debt-free and generating positive cash flow.
Check.
They have a protected technology moat in ProCellEx, 2 commercial products funding operations, and a clear high-growth path dependent on Elfabrio's successful ramp and PRX-115's Phase 2 success.
And they're executing Protalix 3.0, intelligently diversifying their technology base into next-generation modalities like oligonucleotides via strategic partnerships. They're ensuring that their growth story is not finite once their current protein portfolio matures. The foundational achievement is stability. The future value lies in the leverage they gain from that stability.
This deep dive has mapped Protalix's embedded value across 3 major domains. The proprietary protected ProCellEx platform that defines their operational cost advantage.
Right.
2 commercial products providing an immediate sustainable financial floor and a future royalty ceiling.
And a very high-potential competitive pipeline asset in PRX-115 targeting that multi-billion-dollar gout market.
The challenge remains the market's perception, which is hampered by the confusing volatility of their bulk revenue recognition.
It really is. The market is currently valuing Protalix based on the noise of quarterly supplier timing rather than the signal of 24% annual growth and the highly defined $100 million annual royalty stream projected for 2030.
So what does this all mean for you, the learner, today? Given the historical volatility of biotechs, where success often depends on constant future capital raises, a risk Protalix has effectively eliminated with its debt-free status and growing commercial revenue, what fundamental shift in market perception must occur for the trading price to align with the highly defined long-term revenue targets and that $14 analyst valuation? You must consider if the market is correctly discounting the value of a steady, reliable, supply-based biotech against the dramatic royalty-driven growth trajectory they are promising through 2030. Or is the market simply waiting for the definitive Phase 2 safety data for PRX 115, understanding that if that trial succeeds, the company transforms from a specialty manufacturer into a late-stage development powerhouse overnight? That waiting game is the ultimate question in assessing Protalix's current anomaly.